If you are over 60 and you still keep money in a regular checking or savings account, I need you to understand something that could change everything about how you walk into your bank tomorrow morning. The words you say out loud at the teller window, the casual remarks you make while signing a deposit slip, the friendly jokes you share with the person behind the counter. These things can move an ordinary transaction completely out of the routine pile and into a flagged one faster than you can finish your sentence. And the most dangerous part of this entire system is the one thing your bank will never explain to you. Not in the fine print, not in the welcome packet they handed you when you opened the account, and certainly not in the moment when it actually matters. Certain everyday sentences, things said in a completely normal, well-meaning, entirely innocent way, are enough to start an automated compliance review on your account sometimes before a single human being ever looks at your case or understands who you are. You don't have to do anything illegal for this to happen to you. You don't have to be hiding money. You don't have to be dodging taxes, and you don't have to be breaking any law at all. The system does not know you. It does not know you are a retired teacher who spent 30 years in a classroom. It does not know you are a widow who managed a household budget for 50 years. It does not know you are someone who has never bounced a check in 45 years and who has paid every bill on time since before computers existed. The system only knows patterns. And right now, the patterns it watches for are things people say every single day without thinking twice at banks all over this country, in small towns and big cities, in strip malls and downtown towers. This isn't a problem limited to one bank or one state either. Every federally insured institution in the country runs some version of the same software built to the same federal rules, looking for the same handful of patterns that have been programmed into it. A small credit union in a town of 2,000 people uses functionally the same compliance triggers as a national bank with branches in every state and billions of dollars in assets. The software doesn't care about the size of the building or the friendliness of the teller. It cares about whether your words match the patterns it has been trained to recognize. My name is Ethan Caldwell. I am here to represent taxpayers directly in front of the Internal Revenue Service. I sit in rooms with auditors and revenue officers. I read the regulations that most people never see. And I watch the same patterns destroy retiree after retiree who walked into their bank thinking they were doing something completely ordinary. There is no version of this conversation your bank will ever start with you. They will not send you a letter warning you about which phrases trigger reviews. They will not hold a seminar at the community center. They will not put up a poster in the lobby. The reason is simple. If they told you exactly what the software was looking for, people who actually were breaking the law would simply avoid saying those exact words and the system would become useless. So the burden falls entirely on you to know what you're walking into. And most people never do until it's already too late. So today I am going to give you 3 things. The 3 exact phrases that move an ordinary transaction onto that radar. The reason retirees get caught by this more than any other age group, and why the system seems almost designed to target people who have done nothing wrong, and the 5 things careful retirees actually do before a large transaction so their money stays exactly where it belongs, in their name, in their account, on the day they need it, without any surprises, without any freezes, and without any phone calls from a compliance department they never knew existed. None of this requires a lawyer, a special account, or anything complicated. It doesn't require you to move your money offshore or open some exotic trust. It just requires knowing the rules nobody hands you at the teller window, the rules that are treated like insider knowledge but should be common sense for anyone who has worked their entire life and simply wants to access their own money without drama. Stay with me to the end because that last part is the part nobody explains to you for free, and it's the part that actually keeps your account safe when you need it most. Let me start with the first phrase, the one that surprises people the most because it seems so logical, so reasonable, so obviously the right thing to say. It is any sentence that implies you know about the $10,000 reporting line. I want to avoid the extra paperwork. Can we keep it under the limit? Is there a way to do this so it doesn't get reported? Even something as small as I'll just come back tomorrow for the rest, said about a deposit that would otherwise push you over a threshold, falls into the same category. Even joking about it with the teller in a friendly tone, even making a light-hearted comment about how nobody likes paperwork doesn't make it any safer to say. The system doesn't understand tone. It doesn't understand that you've been banking at this branch for 20 years. It doesn't understand that you and the teller know each other by name. It only understands whether the words you said match the patterns it has been programmed to flag, and when they do, the review starts automatically, often before the teller even fully processes what you just said. Here's the system underneath that, the machinery that most people never see, but that governs every cash transaction in every bank in America. Under the Bank Secrecy Act of 1970, your bank has to file a currency transaction report anytime a cash transaction crosses $10,000. That report includes your name, your social security number, your address, and the exact amount and time of the transaction, and it goes into a federal database that is shared across agencies and retained for years. That report is routine. Millions get filed every year for completely ordinary reasons: people buying cars with cash, people making large deposits after selling property, people moving money between accounts for estate planning, and most banks will simply tell you it's required because it isn't a secret. They'll hand you the form, you'll sign it, and that will be that. Worth knowing that $10,000 number was set in 1970 and has never once been adjusted for inflation. By a rough consumer price index calculation, $10,000 in 1970 is somewhere around $75,000 to $80,000 today, which is part of why an ordinary retirement-related transaction, something like selling a paid-off home or cashing out a lifetime of savings, can look on paper like the kind of amount the rule was originally written for, even though in today's economy it might represent nothing more than a modest nest egg being moved for entirely legitimate reasons. The report that actually is kept secret is a different one called a suspicious activity report, and this is where the real danger lives. It has no dollar floor at all. It can be filed on a $500 transaction if the words or patterns match what the software is looking for, and by law, if one is filed on you, the bank cannot tell you. You will never see it. You will never know it exists. You will not receive a copy in the mail. You will not be asked to review it. It simply sits in a database, potentially affecting your financial life in ways you cannot predict, and saying anything that frames a transaction around the $10,000 number pushes you toward that second hidden report, because it can be read as structuring a separate federal offense under Title 31, Section 5324, and it's a crime even when the underlying money is completely legal, even when you have paid taxes on every penny, even when the source is documented and traceable. Here is the part most people get wrong, the part that makes this feel so unfair. Back in 1994, the Supreme Court actually ruled in Ratzlaff versus United States that prosecutors had to prove you knew structuring itself was illegal, not just that you knew about the reporting rule. That protection lasted about as long as it took Congress to notice. Later that same year, lawmakers rewrote the statute specifically to remove that knowledge requirement. Today, prosecutors only have to show you meant to dodge the report, nothing more. They don't have to prove you knew it was a crime. They don't have to prove you had any criminal intent beyond wanting to avoid paperwork. This is not theoretical. This is not something that only happens in law school classrooms. In 2013, the IRS seized nearly $33,000 from Carol Hinders, a 67-year-old Iowa restaurant owner, simply because her routine cash deposits ran under $10,000. She wasn't laundering money. She wasn't evading taxes. She was running a small business that dealt in cash, and her deposits happened to fall below the reporting threshold because that was the natural rhythm of her business. The same year, convenience store owner Lyndon McClellan had his entire account, $107,702, taken the same way. Both eventually got their money back, but only after years of fighting, after hiring attorneys, after media attention, after their lives were turned upside down. Because under civil forfeiture rules, the government can take the money first and make the account holder prove their own innocence afterward, with no criminal charge required. The burden is on you to prove the money is legitimate, not on the government to prove it isn't. Congress did eventually respond, passing a 2019 law that now requires the IRS to tie any structuring seizure it keeps to an actual illegal source, which is real progress and a genuine improvement in the law. But it doesn't stop a seizure from happening to you in the first place. It doesn't stop your account from being frozen. It doesn't stop the months of anxiety and legal bills. The simplest way to stay off that radar is to never frame your own transaction around the threshold out loud to anyone, not your teller, not your spouse sitting next to you, not anyone who might be within earshot of a microphone or a security camera. The second phrase is the one that punishes you for being honest, for being a good person, for caring about your family. It's volunteering language that happens to match a known scam script even when nothing is wrong, even when you are telling the complete truth. My grandson is in trouble and needs this wired today. I met someone online and he needs help getting home. A friend told me about a guaranteed return in cryptocurrency. Someone from the IRS is helping me move my money somewhere safer. Even the Microsoft people are helping me move my account somewhere safer. Follows the exact same script that scammers have used thousands of times. Even a phone call to your bank using these same words instead of an in-person visit triggers the identical review. The software doesn't know you're standing in a branch versus sitting at your kitchen table. It only knows the words. Here is the cruel part, the part that makes this feel like the system is working against the very people it claims to protect. In 2018, Congress passed the Senior Safe Act, which gives trained bank employees legal immunity if they report suspected exploitation of a customer 65 or older. Read that again. It doesn't force the bank to report you. It doesn't create a mandatory duty to intervene. It just removes their downside risk for reporting, which means plenty of banks train staff to flag this exact list of phrases on site because there is no cost to being wrong and potentially significant benefit to being right. Banks have clearly taken that incentive seriously. In 2021 alone, financial institutions filed more than 72,000 suspicious activity reports tied to suspected elder exploitation, up from 62,000 the year before, according to FinCEN's own figures. And it doesn't only catch real scams, it catches a retiree selling a car to a stranger from an online listing, someone who genuinely found a buyer on Facebook Marketplace and is collecting cash. It catches a retiree genuinely wiring a grandchild bail money, because that's what grandparents do. It catches someone moving savings into Bitcoin through a regulated exchange because they read an article about diversification. None of that is illegal. None of that is wrong. The words just happen to match the pattern, and the pattern is what the system acts on. The fix isn't silence, it isn't refusing to explain yourself, and it isn't lying. It's swapping the specific trigger words for plain ones that describe the same transaction without mapping to a known scam script. Online becomes a private purchase. Crypto becomes a personal investment. My grandson is in trouble becomes a family gift. The transaction itself doesn't change. Only the words describing it do, and in this system, the words are everything. The third phrase is the one almost nobody catches until it's too late, until they're sitting in a compliance office wondering why their account is frozen. It's refusing to answer a teller's routine question. That's none of your business. I don't have to explain my own money. You are completely right that it's your money. You are completely right that in a free country, you shouldn't have to justify every withdrawal to a bank employee. But under the Bank Secrecy Act's Know Your Customer rules, the bank has to be able to explain unusual activity in your file if they are ever audited or questioned. And a flat refusal is frequently treated as the red flag itself, not because you did anything wrong, but because an unexplained transaction is exactly what the system is built to escalate. It is the absence of information that triggers the review, not the presence of wrongdoing. Picture two retirees, each withdrawing $9,000 for a roof repair. One says a home repair and is out the door in 30 seconds with cash in hand and no follow-up. The other says, that's between me and my contractor, and ends up on the phone with the bank's fraud department later that day for the exact same legal withdrawal of the exact same amount for the exact same purpose. The only difference was the words. Decades of loyalty to one branch don't change this calculation either way. Being known by name doesn't matter. Having a Christmas card from the branch manager on your refrigerator doesn't matter. It simply isn't part of how the decision gets made. The software makes the initial call, and the software doesn't have a field for customer loyalty. So here's what I want you to do. The exemptions, the breaks, the refunds, most seniors already qualify for but never claim. I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites that seem designed to hide information rather than share it. Everything's laid out fast and simple, so any senior can find exactly what applies to them, whether they're in Florida or Montana, whether they own a home or rent, whether they're still working part-time or fully retired. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need organized in a way that actually makes sense, not the way government websites are organized. Now, stay right here because the next part is the exact sentence that protects you in every one of these situations. And it's the reason I made this whole video. So, the question you've been waiting for, what do you actually say in the moment that satisfies all three of these at once? One sentence, true, brief, boring. Not silence, not a story, not a performance, not a defense of your rights. Just a plain description of a legal transaction said in a voice that doesn't suggest anything unusual is happening because nothing unusual is happening. Here are the 5 things careful retirees do every time to stay on the right side of all of this. The habits that separate people who have problems from people who never do. The first thing is preparing one short true sentence in advance for any large deposit or withdrawal. Personal expenses, a home repair, a family gift, nothing about avoiding paperwork, nothing about a limit, nothing that references the system itself. Decide on that sentence before you leave the house, not at the counter while a teller is waiting and you feel pressured to say something. Rehearse it if you need to. Write it on a slip of paper in your wallet if that helps. The second thing is letting a transaction over $10,000 just be over $10,000. Sign the routine form without comment, without sighing, without making a joke about Big Brother watching. It's ordinary paperwork, not a flag. Millions of people sign these forms every year and nothing ever happens to them. And treating it like a secret is what actually turns it into a problem. The third thing is swapping the scam pattern words for plain ones before they ever leave your mouth. Online becomes a private purchase. Crypto becomes a personal investment. My grandson is in trouble becomes a family gift. The transaction itself doesn't change. Only the words describing it do, and the words are the only thing the system can hear. The fourth thing is never refusing to answer a routine question, no matter how irritating it feels, no matter how much you want to assert your rights, no matter how many times you've been asked before. One sentence and you're done. A flat refusal is what actually invites a closer look, not the honesty. If the questions ever feel excessive, if they go beyond what seems reasonable for the transaction, you can simply ask to speak with a branch manager instead, which is a normal request and doesn't carry the same risk as stonewalling. The fifth thing is gathering documentation before you ever walk in. A bill of sale, a gift letter, an estate document, so the source of the money is already on paper the moment anyone asks. If you're planning something large in advance like a settlement or an inheritance, calling the bank ahead of time removes the surprise that triggers most of this in the first place. A phone call saying, "I have an estate distribution coming next week and wanted to let you know," can prevent a review that a sudden $50,000 deposit would almost certainly trigger. If a pattern in your own statements ever looks like it might draw attention, if you've been making regular deposits just under a threshold or moving money in ways that could look unusual on paper, this is also the point to have a licensed enrolled agent or tax attorney review it with you beforehand, before the bank's software does. That's the exact framework I walk clients through before any significant banking transaction, and it's the framework that has kept countless retirees out of the compliance system entirely. Now, let me tie this all together because the thread running through all 3 phrases is the same one, and it's the thread that most people miss. None of this is about hiding anything. It's not about being evasive or deceptive or clever. It's about understanding that an automated system reads your words for patterns, not for intent, and a small handful of ordinary, well-meaning sentences happen to match the patterns it's trained to escalate. The system doesn't know your heart. It doesn't know your history. It doesn't know the difference between a criminal and a grandmother who has never done anything wrong in her life. The fix isn't secrecy, and it isn't oversharing. It's one plain sentence said the same way you'd say it to anyone else, with nothing in it that maps to a known trigger. You're not being asked to lie or to be cold with a teller doing their job. You're being asked to describe your own legal transaction in the same plain language you'd use with a neighbor over a fence. It's the difference between answering a question and performing an explanation. And tellers are trained to notice which one they're getting, not because they are suspicious of you personally, but because their own training tells them that excessive explanation often correlates with someone who is nervous about the transaction, and nervousness is another pattern the system watches for. No one at your bank is going to call ahead and coach you through the right words. The teller asking the question isn't going to explain why it matters or what happens if you answer wrong. They are trained to ask, to listen, and to report, not to educate. Andrew Clyde, a Georgia gun shop owner, found that out the hard way in 2013 when the IRS took nearly $950,000 from his account over a structuring claim. It took him years of legal battles, a partial settlement where he gave up $50,000 just to get the rest back, and a law named after his own case before Congress tightened the rules even slightly. He hadn't done anything criminal. His deposits simply matched the pattern the software was built to catch. The pattern of deposits just under $10,000 that looked like intentional structuring, even though they were simply the natural result of his business's cash flow. His case is a reminder that good intentions and decades of honest dealing offer no protection once a pattern matches what the software is trained to flag. The system is indifferent to your character. The only person who can make sure you're using safe, accurate language at your own bank is you. And doing it right is far simpler than any of this sounds. One sentence. True, brief, boring. That's all it takes to keep your money where it belongs. In your name, in your account, available on the day you need it, without any drama, without any compliance reviews, and without any of the fear that too many retirees live with simply because nobody ever told them the rules.